Now, SBG Securities is an institutional stockbroker wholly owned by the Standard Bank Group. Risto Ketola, insurance analyst at SBG Securities, joins us now in the studio to tell us about their investment strategy when it comes to the insurance sector. Risto, thank you very much for joining us this evening. I found a PwC report that came out at the beginning of June. I don't know if you saw that, but according to the industry, they're looking at average growth in the long-term insurance sector between 15 and 20% this year. Short-term insurers are expecting growth in profits of between 10 to 15%. Is this believable, given the fact that we saw, for example, ABSA coming out today saying that credit impairments are rising, hitting their mortgage book, really signs of consumer stress coming to the fore?
Those particular numbers look a little bit high. If I think of life insurance, I think it's more realistic to expect profit growth of about, let's say, 10 to 15% tops. Part of that is Old Mutual's earnings growth will be quite strong, but a lot of that is Nedbank's earnings growth, so it's more the banking sector driving group profits. If you look at pure life insurers like Sanlam, they're looking at high single-digit growth. I think a bigger disjoint there is the short-term insurance industry actually got earnings going down there. We're seeing quite big pressure on underwriting margins. You're looking at motor insurance, you've got claims inflation with the weaker rand, you've got a lot of competition in that sector. You're coming off very high profits on some specialist lines like liability and credit insurance. So I think the insurers are probably being optimistic on those numbers.
But Risto, when you look at the whole life insurance industry, this industry went ex-growth a long time ago. I mean, basically everyone who's got a job has already got 5 insurance policies. What are the growth vectors? What can happen? Must we get 5 million new jobs before the life industry grows again? Or do you just go trying to steal something from your competition? Or the way my company's gone is takeovers?
Yeah. We perceive the long-term growth or medium-term growth prospects quite weak, so below GDP. We recently did a report where we compared growth expectation in banks, which is above nominal GDP, and life insurance, where we think the industry will do well to do, let's say, 8% per annum over the next 5 years in earnings growth. The area of pressure that you're talking about is really in the savings policies, where the revenues are too high. Basically, the fees were too high. The modern products offer better value for money, but it does mean that your revenue per rand of assets is declining. You had good growth from risk policies, but that is only offsetting the margin pressure on savings policies. So your analysis is right that there's very few. Well, industry level, the growth prospects are pretty dire. Now, obviously, you have companies like Discovery that have carved nice niches for themselves. But I'm not going to, if you're buying a life insurer on a 20 PE expecting it to grow its earnings, you're kidding yourself. I mean, the sector trades on a, let's say, a 8 to 9 forward PE most of the time, which I think is reflective of the growth potential. So
pretty much priced correctly if you're looking at the average right now. What about regulatory changes right now and how that's going to affect perhaps capital and the ability to grow? Because many insurers like MMI, like Sanlam, said to be sitting on large capital and discretionary capital right now.
Regulatory change is an ongoing thing in this industry. I think life insurers, like banks, they're fiduciaries of people's money and savings, so they're always going to be highly regulated. I mean, whenever you're making good profits, I think the regulator will perceive that you can offer better value for money to your consumers. So regulatory change is ongoing. You mentioned capital, so we have Solvency II project in Europe, which in South Africa has been run as SAM. I actually don't expect it to have a massive impact on the surplus capital disclosed by these life companies. So you mentioned Sanlam. Sanlam's got about 3 billion rand of excess capital, which is, 5% of market cap. It's not as big as people probably think it is, mainly because it's fallen in absolute terms and the share price has gone up so much over the last 5 years. MMI has got about 4 billion excess capital, but they're in no rush to deploy it. The short answer is,
well, they have recently, they bought out the short-term insurer yesterday, so that is an indication they are putting some of that money to work.
Yeah, but I mean, these deals are a few hundred million rand at a time.
Yeah, 150 million rand.
That's
so
right.
Of the 4 billion rand that it's sitting.
Yeah, I mean, great. You make good acquisitions like that, I don't mind. What I wanted to get to is, whenever somebody tells me I'm buying Sanlam because of excess capital, I often think you're kidding yourself if you're taking 1.50 rand per share of excess capital on a 33 rand share price, and you start constructing a buy argument from that. I wouldn't buy these things for excess capital. There's not enough of excess capital there to justify that being your rationale.
Obviously, when they're laggards and they're ones that are outperformers. So what are your views on the long-term insurers, if we could focus on that area, that you're expecting to perhaps deliver some returns in 2012?
Look, Sanlam's trading above its embedded value. Now, just for the viewers, embedded value is, in theory, the current value of future profits. Now, simplistically. So a share should trade a little bit below that because future profits are always uncertain, whereas Sanlam is trading now above that, whereas Old Mutual still below. Now, we were very fortuitous and we bought Old Mutual right at the bottom when times were dire, and we've done extremely well out of it.
What price did you buy it at for interest sake? Because of course, you know,
64 and 70 or something.
2075 is where it rallied to this month. Yeah.
But I mean, that's just, you know, there was an element of luck there because, you know, the whole world was coming to an end and everyone thought Old Mutual wouldn't survive. But besides that, the whole point is we've had a good run out of Mutual now. You know, it doesn't look immediately apparently cheap in relation to other shares. You know, maybe even after today, ABSA. Maybe we should buy ABSA instead of Old Mutual.
Yeah, I mean, it's quite hard to compare banks and insurers, but if you look at just price earnings ratios, I mean, Mutual is still trading at only about 8 times forward earnings. So it's still cheaper than the banks, even after the rally it's had. Whereas Sanlam on a PE metric is trading at 12 to 13 times forward. So Sanlam is a generally expensive financial stock. I mean, there's no doubt about that.
But they had good results, sir.
They had good results, but I think people are paying an excessive quality premium there. Okay. I mean, its growth prospects are not that different to companies like Liberty and stuff. But people are looking at the track record of delivery and are prepared to pay huge numbers. On Old Mutual, I think my answer would be that it's still our preferred stock in the sector. It's trading at...
Why is that? Tell us why you buy Old Mutual
well, the valuation,
after the restructuring process.
The valuation is still very cheap. Now, I think there's a lot of what's called sort of anchoring taking place because the share price has rallied from 6 Rand to 20 Rand. People automatically think it's cheap. The reality is that the embedded value of the company through the restructuring and recovery of global markets has also increased dramatically, which means the ratio of current price to embedded value is only about 0.67 times, which makes it comfortably the cheapest of the South African insurers, and also makes it quite cheap within the global insurance space.
Do you need to look at the question marks and the concerns that one might have around Old Mutual given its international exposure right now? Because, of course, as you say, you need to compare it on a global scale. You consider it to be cheap right now, but there must be a reason why it's trading at that discount.
Well, the markets are wrong sometimes. No, but I mean, the reality is that they have exited the US life insurance business. They have significantly curtailed their other US exposures, both in asset management and variable annuity business. They have sold their Swedish business. The reality is that 2/3 of the value, at least, resides in South Africa again. So when you're comparing of multiples of Old Mutual, I would rather compare it to Sanlam than to Prudential now. I mean, the business has refocused back in South Africa. I mean, the business they have left overseas mainly is in the United Kingdom, where they sell what's called platform business, which is linked investment business. There's no risk to it, really. It's like running a mutual fund business. You know, your revenues go up and down with the markets, but there's no bankruptcy risk or any major guarantee risk in that business. So,
but then when they're coming home, because I mean, the platform business is not exactly a big growth business and small margin. I mean, it's very small margin.
Yeah, it's a fast growth business, but the margins are razor thin.
Yeah.
I mean, long term, we're expecting that you'll be doing well to make 10 basis points on that, which is even lower than your trust companies make in South Africa. Now, Old Mutual is a leader through Scandia. So Scandia is the largest platform, like what we will call LISP in South Africa. It's got assets of in rands about 400 billion rand, which will make it a much bigger than any of the LISPs in South Africa. I tend to agree with Wayne. That business, I think the downside scenarios are quite significant because everybody wants to get into a growth market, one of the few growth markets within retail savings in UK. And secondly, the margin compression could be very substantial. So if I was Mutual, I probably would be looking at selling out of the UK and totally returning back to SA.
Interesting point that you make there. Before I let you go, you talk about growth markets. We know that the likes of MMI are looking to grow in India, Sanlam, Old Mutual already there. Sanlam, in fact, indicating Indonesia and Malaysia are growth areas. So where's the growth going to come from outside of South Africa? Who's best positioned in the insurance space to take advantage of that?
Right now, Sanlam's probably got the best platform. So Sanlam has a small business in India. Old Mutual's actually got a much, much bigger business in India. But because of all the problems in the group, it doesn't get much focus. But if we look at Africa, which is really, really hot in terms of investment attraction at the moment, Sanlam has a very broad set of businesses. It's got quite big businesses in places like Namibia and Botswana. But it's also got good platforms in Ghana, Nigeria, Kenya, Uganda, a lot of the more growth markets. So right now, Sanlam is quite attractive. I mean, Africa still makes up less than 10% of group earnings. I think Mutual, now that they have lots of cash and they want to refocus back on their own markets, I think you're going to see Mutual go out for a big African expansion. I think they're going to be spending a lot of money trying to get leadership position in markets like Kenya, where they're actually quite small, and in Nigeria, where they practically not in at all at the moment.
And of course, insurance penetration in Africa is still very low, so lots of scope for growth on that end. Thanks so much for coming in today. That was Risto Ketola, insurance analyst at SBG Securities.